Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Wolf Richter, publisher of WallStreet.com. He's speaking to us from San Francisco. Welcome back to the show, Wolf.
Thanks for having me back, Jim.
Wolf, where are long-term interest rates going?
Well, right now they're ratcheting higher. The 10-year Treasury yield has more than tripled since August. So it was at 0.5% back then, and now we're at 1.64%, the highest in over a year. And this is happening while the Fed is still buying Treasury securities and mortgage-backed securities in the amount of $120 billion a month, roughly, or it's adding to its portfolio, is increasing its portfolio by that amount. And so these purchases have the purpose of pushing down long-term interest rates. And despite QE, despite these efforts to push down long-term interest rates, they have been rising. So you can see how much upward pressure there is on these long-term interest rates. If there had been no QE over the last few months, the question will be how much higher would long-term interest rates be now? And obviously, that will be quite a bit higher. The market is reacting to inflation pressures that are now popping up everywhere, and to the Fed's insistence that it is not going to do anything about inflation for a while, that the first big bout of inflation is going to be considered temporary and a one-time thing, and they're going to just ignore it. And if inflation is above target for quite a while, or it becomes quote-unquote unwelcome inflation, then they might eventually do something about it. So at this point, the market understands that inflation will be allowed to rise, to continue to rise. The market sees the supply constraints everywhere now in the durable goods sector, where these stimulus payments have caused a historic surge of demand, and there's all kinds of shortages cropping up and causing price increases and those kinds of things. So when you have a 10-year investment and you're buying it at a yield of today's rate of 1.64%, it means that for the rest of the duration of that investment for the next 10 years, you're going to get a yield of 1.64%. And when interest rates, when inflation rates go up past 2, maybe 3 or 4%, that's starting to be a really iffy deal. And so that the market is kicking this around, and the market is heavily influenced by the Fed's own purchases. So that's the downward force. On the short-term side, interest rates are locked down to near zero. They haven't budged. That's where they are. That's where the Fed keeps them with its policy rates. So long-term interest rates have risen in other countries too, and even where, like in Europe, where the central bank, the ECB, decided to increase its asset purchases to combat those rising long-term rates, and yet they're still going up. Now in Europe, they're negative, like in Germany, they're negative, but they're less negative now than they were. In some other countries like Italy and Spain, they're positive, but they're slightly higher than where they were. So, inflation is when inflation gets serious, long-term interest rates are going to follow, and if they're allowed to, if the central banks allow them to follow. And that's the case right now in the United States. So the Fed has essentially said, okay, we're comfortable with rising long-term rates as long as there's a sign of rising inflation expectations in the growing economy, and not of financial stress or panic or whatever. And so long as it's orderly, and that's been the case, So they've let them rise, and they've not really counteracted. And even after today's Fed meeting, the 10-year Treasury yield is still 1.64%. So, I think 2% will be the next stop. And at some point, this could get very painful. It's already painful for long-term, for investors with bond portfolios with long maturity. So, these Treasury bond funds that specialize on 20-year maturities and higher, they're down 15-20% already from August. So these are big losses to take on these long-term bond funds. Corporate bonds, high-grade corporate bonds are down too. So there's been quite a bit of pain. But when the 10-year Treasury yield goes past 2%, it gets more critical. At 3%, last time it went to 3% was in the fall of 2018, and it entailed a 20% sell-off in the S&P 500 index. It caused the Fed eventually to do a U-turn on its interest rate policy, and so it caused the housing market to stall because mortgage rates were going up, and mortgage rates in the United States are already going up, so they're still very, very low. But they started rising in January, and they've continued to rise, and so we already saw refinancings go down. That's a national pastime in the United States. When interest rates drop, you refinance your home and maybe pull some cash out that way. So because home prices have gone up, they can refinance at a higher rate and so pull out some cash. That has started to slow down. And, home purchases are still hot, but, rising mortgage rates will eventually impact those too. And the Fed looks at this and says, well, okay, that's how it is. And it may welcome a little bit of a tightening in the housing market and in some of the other craziness, that goes on in our financial markets. And so far that's what we'll see. And I think at 2% they're still fine, but when it heads to 3% in the current environment, with the Fed still buying, treasuries, I think that will probably be beyond, what they will endure, and it will cause a lot of damage in the financial markets.
We'll have more with Wolf Richter right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Wolf Richter. Wolf, do you see changes in what businesses are doing that will outlast the pandemic?
Yes. Every day, when you interact with a business, you see what they're doing. And what they have done is they have invested in technology in order to deal with the issues that the pandemic served up. And one of the big examples that I ran across is when I went skiing a week ago. And this is Royal Gorge, so this is a cross-country ski area, said to be the largest cross-country ski area in North America. Now, I'm sure there's somebody in Canada that's going to disagree and is going to show me an even bigger one. But, it has 120 plus miles of groomed trails and when they're groomed, and, which is not always the case. And this is a struggling ski resort. It went bankrupt years ago, and it got bought out by a downhill ski area, and they're open now, and they've made some improvements. But it is an entirely low-tech affair, or it was. And so you bought your ticket your trail pass every day when you went up there. You stood in line, and the trail pass went on your pole as a piece of paper, self-adhesive, and then you have to scrape it off at night, and in the morning you have to buy another one, and so that's how it was. And there's a lot of time spent indoors inside the lodge to buy these things and deal with the logistics. So now when we went, they upgraded their website. So it used to be just for information. Now it is an e-commerce site, and you have to buy the trail passes online. And if you rent equipment, you have to pay for that online, and you have to schedule your visits and your slots online. And then that you get a code, and with that code, you go to an ATM type machine that's outside the lodge, and it's a code that is visually scanned by the ATM, and you can use your smartphone, or you can print it out on paper, and then this machine spits out your trail pass. It's a credit card looking thing that has all the information on it, and you can recharge it online. You can recharge it next year. They read it at the entrance of the trail system via a radio reading device, so they don't even have to touch it, and you can leave it in your pocket. This technology has been around for a long time. It's been around for 15 years or something, and they should have installed this 10, 15 years ago, because it is such a big improvement for users. You just park, you put your stuff on, you scan your thing, and you go. And it takes half an hour or more out of the preparation time, especially on busy days. It can be an hour before we can go skiing. And these things are not everywhere. It's for users, it's a definite improvement in terms of the payroll of that place. There's quite a few people that are no longer needed that used to do this, but now you have other people that install the equipment, that built the website, that maintain the equipment, that supply the cars and all the stuff that goes with it. And so the employment shifts around, but the local employment in the service sector, that has probably been cut down quite a bit, because you don't have to you have technology and automation and consumers doing it themselves online replace what local employees used to do in person. And so that's the drawback. You have a lot of those shifts from employment to technology. In the healthcare sectors, this is now big time. With COVID, you cannot just walk into a doctor's office anymore. It's gotten very complicated. So telemedicine is now big. It has been around, but now health care providers are investing in it in a major way, upgrading their video systems. So now you get doctor's visits over video. And, you still have to go in for certain things, but the easy to deal with stuff that doctors look at, it takes them 30 seconds to figure out what it is. The routine stuff you can do via video. You can send in photographs of the infection or whatever you have, and they can look at it, and it saves you the trip to the doctor's office. It's a lot cheaper. With my healthcare provider, these things are now free. So it goes, restaurants have automated all kinds of stuff. The whole entire supply chain system is going through that. It's everywhere now, whether it's consumer facing or business to business. This technology has taken over, and it's impacting work from home. That has been, all these technologies have been around, but now they've been put to work, and it's showing that actually work from home can be functional. It can be very efficient. And, most companies are starting to plan for a hybrid type work environment where people come in for certain types of things and they stay at home to do other things in terms of office workers. And, production workers and manufacturing, construction workers, those kinds of jobs, they will always be on location. But in terms of office work or, engineering work, architects, those kinds of people, they can do their work pretty much from anywhere and then only going to the office for certain types of things. Ford came out with that. Ford is a big manufacturer, but they have lots and lots of people globally that don't work at their plants. They work in an office somewhere and do all kinds of office things, including designing new products and doing financial stuff and accounting and whatnot. And Ford just came out and announced that 30,000 or so of its employees may not go back to the office. And they're going to be on some kind of hybrid schedule going in. The entire company will be going in when it's needed. And so they developed this whole technology to deal with it. They've tested it. It works. They've upgraded their communication systems. Their employees have, some of the expenses shifted to employees. And so these changes won't go back. I mean, this technology will not be abandoned. So this is there, and it's making all kinds of new things possible. And some of it for consumers is an improvement, and some of it is maybe not so much of an improvement. And you'll be tasked to do things that the company used to do. For employees, it may be an improvement depending on how you look at it. Some people really love the office environment and love to go in, and others would really rather work at home. And this is how it may shake out, that people will choose employers based on whether it's work at home or whether it's an office job. And for workers that lose their jobs because of some of these efficiencies, that's a real issue. Now, work from home also means that your job can be done by somebody in a cheaper country. So, if you're an engineer and you're not top notch, but you're at one of the lower levels, you can probably be replaced by an engineer in some other country, and that will happen. So there are all kinds of drawbacks to that too. And these kinds of changes, automation in general, but these kinds of changes can't be unwound. It's like the sun rises, the next day. This is going to happen. You can't stop it. This is moving forward. And, there will be a lot of good things coming out of this, and there will be a lot of tough things coming out of it, like jobs going away, and especially service jobs, that customer-facing service jobs, as we've seen in the ski resort. And I don't think that there's a way back to the old normal. The old normal in terms of interfacing with companies has disappeared. There's going to be the new normal that we're now seeing, and this is going to be built on and fine-tuned and improved as we go forward.
Do you see governments putting a special tax on automation or robots to help support all the people laid off by the machines?
Well, they could try to do that. I mean, one of the things they could do first is to take away the investment tax credit. So that's a subsidy for investing in robots and automation, and that could take away the subsidies. That would be the easiest thing to do. That hasn't happened yet because every economy wants companies to invest. That's part of GDP. That's part of the economy. So when a company spends $1 billion automating a plant, that $1 billion goes into the economy. It goes not just in the local economy, it goes into the global economy. And so that's a big thing, and so that's hard to discourage. At the same time, what do you do with the lost jobs? And so the assumption has been that automation will always create different jobs and new jobs and better jobs, and that it will work out. And that assumption has been now blown out of the water. It's not working out on that, and we've seen that. So then the question arises: what if we tax production that is done by machines? And they could do that. There's a possibility that we'll do that. I have not seen anything coming out of the Biden administration on this yet. these proposals are being made by economists, but not by administration. So I don't know if this idea will go anywhere. I think the first step, if a government wants to oppose investment in automation, that's what this policy will do. It will put a tax on investment in automation. If a government wants to do, the easiest thing to do is to take away the investment tax credit, and that will create lots of funds for the government to support the laid off employees.
I saw a survey that said up to 80% of New York office employees who are currently working at home would like to continue working from home and not return to the office. What are businesses going to do with all that empty office space?
Well, so let me just respond to that survey. Businesses in the end won't ask their employees what they want to do. So they will listen to the employees to some extent. They will try to provide an attractive work environment so that they can hire good people. But if businesses want the employees to show up at the office, they will demand that. And and then when an employee doesn't want to do that, they can go find another job where they don't have to do that, where they can work at home, and the business will hire somebody that likes to go to the office. So that's how that will shake out. But yes, in terms of landlords, in terms of office landlords, this is a real challenge, and nobody really knows how this is going to shake out. Right now, like in San Francisco, the financial district is just abandoned. It's just totally empty. And other cities are in a similar position. And some of this will go back to more normalish levels, but be below. So by maybe mid this year or later this year, more companies will bring back more employees to the office, and some of those office buildings will have more people in them. But if occupancy drops so the post-pandemic occupancy drops by 20% from pre-pandemic occupancy, so that's a big issue. Then you have another issue that in hot office markets like San Francisco, companies were warehousing office space. So they leased office space without needing it at the moment, so that they could grow into it over the next few years. And it's this empty office space, so that's never been occupied. So it's been empty from get-go. That's the empty office space that's showing on the sublease market, because companies realize they're not going to fill that empty office space ever. They didn't need it in the first place, and now they're trying to get rid of it. And so we're not even really discussing that seriously, because we have overbuilt these office centers, and because companies created this artificial demand because they were leasing space that they thought they might need, and because there was so much demand for office space, they leased it whenever it came up, years in advance, so that I could sit on it and have it. And this artificial demand for office space created more artificial demand, and now this whole thing is reversing. So we've got a lot of office space that's never been occupied. And, and that's in addition to the office space that is now going to empty out. So there's a lot of unused office space out there that will have to shake out. And, in some expensive cities, they have taken older office buildings, so older office towers, and converted them to residential units. That can be done. I've seen them do it in Manhattan 20 years ago already. This doesn't work with new office buildings. So this is the lower end, older office building that will be gutted and will be converted, and it takes quite a bit of money to do that. They will essentially just use the structural parts of the building, and they'll convert it into a residential building. And in a place like San Francisco, where you can rent a two-bedroom apartment for a high-end two-bedroom apartment for $5,000, $6,000 a month, and where the median condo sells for $1.1 million. you can make that work possibly, but in lower cost cities, that equation doesn't work at all. And it only works for older buildings that maybe a developer can buy from a bank after the landlord, sent the keys to the bank, said you can have this thing, and instead of trying to pay off the mortgage. So I think there will be some conversion to residential in some of the more expensive places like San Francisco, but that takes many, many years. You've still got some occupants in it. You need to get them out. You need to get the permits. You need to do all the stuff, and then you need to do the project. So, it's not, and you need to have demand for housing. In San Francisco, lots of people have left, so there's a lot of vacancies now. But yeah, that's the option they have, and other than that, they can just wait for, the demand for office space to return somehow. And some of it will, eventually, but not all. And so I think for landlords, this is going to be pretty tough out there. Now, if you have a Class A building, a brand new building, you will always find companies that want to be in that. It's the older buildings, that are no longer competitive in a market like that, and that will lose the tenants, and they will eventually default on the mortgage. So, it's not the brand new buildings that they built that are, equipped with all the best stuff. It's the older buildings, that get in trouble.
We'll have more with Wolf Richter right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Wolf Richter. Wolf, what's the latest on auto sales?
Yeah, so in auto sales, we now have a supply shortage. And when you go to the dealer and you're trying to buy a popular model, if they have it at all, you're going to pay for it. And the supply shortage was in the making late last year, and the first big issue was the semiconductor shortage, and the stimulus payments in the United States and in some other parts of the world have caused a historic spike in demand for durable consumer goods. And so appliances, cars maybe not so much as car sales are still below where they used to be, but in lots of other goods. And everything has semiconductors in it these days. And, you the rowing machines on back order, bicycle trainers on back order, everything is computerized, low-end laptops, the whole thing, so semiconductor manufacturers could no longer keep up with demand, and that started filtering into auto supply chains late last year, and automakers and auto component makers started warning about it. So then this year, so in January, we started to get the first announcements in the United States and in Canada from the major automakers that plants were being shut down because of component shortages due to semiconductor shortages. So that's January, February, all the major automakers started shutting down either shift or entire plants. And that includes the Ford F-150 plant, or shifts were eliminated because of the semiconductor shortage, and that's the number one best-selling vehicle in North America. It included the Japanese automakers in the United States. So Honda and Toyota both have announced major production cuts at their plants. And so the whole industry is facing the same thing. And so that's January, and then February, Then in mid-February, we get this winter storm to hit Texas. And, talk about timing. So there are a number of large semiconductor plants in Texas, and including Samsung has 2 plants in Austin. And those 2 plants shut down, and they're still shut down. They're shut down because of the cold weather caused blackouts and caused the plants to close and caused some damage at the plant, and the production still hasn't come up. In addition, there are now shortages in the petrochemical industry because so that's Texas also. The industry was shut down during the blackouts and the cold weather, and so we're talking about plastics. Everything has plastic in it. Lots of plastic in cars, and so now there's a shortage of plastic coming up. And Honda, for example, also mentioned as one of the reasons for shutting some of its plants is that were damaged by the cold weather. There's pipes that broke, and there's other damage that occurred. And so this winter storm made the semiconductor shortage much worse. And so now it caused additional production cuts in semiconductors, and it damaged some of the auto plants. And it caused transportation delays and all kinds of other things. And on top of that, we've had for months a huge backlog in the shipping industry. There's container ships on the West Coast waiting to get into port, and they're waiting there for days, sometimes for weeks, and they have trouble getting in. There's a container shortage. There's a shipping shortage in Asia that can't get their stuff over because the ships are tied up waiting to get to the ports over here. And so now you've got all these components in containers that can't be unloaded, that are on the ship somewhere, and that can't be unloaded because of the port backlogs. So the auto industry is now facing a major supply crunch. And there are thousands of semiconductors in each individual car. Every little thing has a semiconductor in it. When you roll up your windows in a car, that's controlled by semiconductors. Your infotainment system, your engine control systems, everything has lots of semiconductors in it. And if just one semiconductor is in short supply, you cannot build that car. You can't complete that car. The car just sits unfinished or doesn't even get built in the first place. And the auto industry is known for its complex, long global supply chains. It's known for its long lead times. Production is planned months in advance. Just-in-time inventories is the key to the industry. So the inventories are really tight. And so you get something like this, and the disruptions just ripple through it. And so not just semiconductors, but also the backlog in the ports and the damage caused by the winter storm, and all of it coming together. So already, these are production cuts that are happening in January, February, March, continue into April, and so we're going to see and already seeing on dealer lots how the supply is not coming in as it should, and so there's a lag there. So a vehicle is being built in the factory, so when it's set up to be built, from there until it shows up on the dealer lot, there's just some time lag. So now these shortages are starting to show up on dealer lots, and going forward, they will continue to do that. Volkswagen said that it will try to catch up by the second half of this year. So this is not something that's just going to go away in 2 weeks. So the plants some of the plants might reopen in April. The semiconductor companies are trying to ramp up production, but it's really hard to do. They're running at capacity. Even if they could, they can't get the components into the supply chains because of the shipping backlogs. So this will take a long time to untangle. And meanwhile, you have customers getting stimulus payments, and they want to buy a car, and they're going to the dealer, and they see the shortage, and the dealer is not negotiating; they're selling everything at sticker. If you're short on pickup trucks, that as a dealer, you're not going to make a lot of good deals on the ones that you do have. And so, this is going to ripple through the retail side of the auto industry over the next few months, maybe for the rest of the year. And, consumers probably will end up paying higher prices. Probably a pretty good time to not buy a car, just to let this blow over. And, this, I've never seen anything like this. I mean, this confluence of somewhat unrelated events causing so much havoc in the auto industry it's just amazing. Plastics will probably, that's something that will probably be resolved sooner than the semiconductor issue, but plastics is just so widespread and that go into everything. I mean, that involves other things too, consumer electronics, housing constructions. I mean, PVC, the price of PVC, we have PVC pipes, that doubled, recently. So because of the shortage. So this is causing all kinds of stuff. And a minute ago we're talking about inflation and these may be one-time events, but they're going to hit prices. That's for sure.
Wolf, thank you so much for chatting with us.
Thank you, Jim.
And for all the HowStreet.com listeners, we have a special treat. Friday, March 19th, I'll be hosting a webinar with Rick Ackerman, editor of the newsletter Rick's Picks. And Rick has a particular point of view that a lot of people don't think is going to happen. So many economists are predicting that we're going to be facing hyperinflation. Rick, you have a different point of view. Why do you think deflation is going to be the big problem we face in the future?
Well, first, thanks for helping me to put this together, Jim. I do think that the end game will feature deflation. We've got such an acute mania going on in all investables right now that even the bulls must be forced to see that it's not going to end well. So as far as I'm concerned, the bad ending is going to be deflation rather than inflation. And although that sounds counterintuitive because of all the credit stimulus that's going on, I think in the end it's debtors that are going to get stuck, not lenders. And that implies in deflation, it implies a strong dollar, a crushing burden of real debt. It implies that we're never really going to get out of our mortgages by being able to pay our lenders in $100,000 bill snide. So that's where I think things are going, and I'm in a very small minority with that scenario.
And Rick, what's the website they should go to?
Yeah, that's rickackerman.com. If you go to rickspicks.com, you're going to find a New York-based pickle and relish vendor. So rickackerman.com is where you want to go. You can sign up for 2 free weeks of everything I offer, including a couple of great trading rooms for just $1. So that's just click Start Trial at the top of the page, rickackerman.com.
So join us Friday, March 19th for a webinar with Rick Ackerman about deflation. It starts at 10 o'clock Pacific, 1 o'clock Eastern Time. I've been speaking with Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. If you have any questions for Wolf or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.